Hi, good afternoon, everyone. Welcome to the webinar entitled Bonds 101. Thank you for being with us today. My name is Tony Bautista, CFA, Financial Market Sales at Standard Chartered Bank, and I am your host for today's online event. So before we proceed to our program, may we please call on Ms. Rochelle Manaog, CPAE, for the invocation.
Let us place ourselves in the presence of the Lord. Heavenly Father, we offer everything to you during this webinar. May we ask for your blessing that the learning session set for this undertaking be successful and effective. May we also retain the invaluable knowledge and learning that we derive from this learning session. We pray that you bless all the people involved so that they may fulfill their tasks responsibly, that the objectives we have set may all be achieved. Your generous blessing would mean the success of this webinar. We pray all this in the name of Jesus. Amen.
Thank you, Rochelle. Please remain silent for the singing of the Philippine National Anthem.
Mga kababayan, ang pambansang awit ng Pilipinas.
Bayang magiliw, pelas ang silanganan, alab ng puso, sa dibdib mo'y buhay. Lupang hinirang, duyan ka lang magiting, sa manlulupig, di ka pasisiil. Sa dagat at bundok, sa simoy at sa langit mong bughaw, may dilagang tula at awit sa paglayang minamahal. Ang kislap ng watawat mo'y tagumpay na nagriningning, ang bituin at araw niya kailan pa may di magdidilim. Lupa ng araw ng walhati pagsinta, buhay langit sa piling mo. Aming ligaya na pag may mga api, ang mamatay ng dahil sa'yo.
Again, welcome to the webinar entitled Bonds 101. We would like to take this opportunity to recognize our annual corporate sponsors. Our platinum sponsor is National Home Mortgage Finance Corporation. Our silver sponsor is FTI Consulting Inc. And our bronze sponsor is Infinito. This webinar is brought to you by the CFA Society of the Philippines in partnership with the Bureau of Treasury. Today, we will learn about key concepts and terminologies that will help us navigate the ins and outs of investing in bonds. We will then talk about available bonds from the BTR that you can invest in. So to formally welcome us, may we please welcome the President and the Chairman of the CFA Society of the Philippines, Dr. Robert Ramos, CFA, CAIA, CIPM.
Thank you for the kind introduction, Tony. On behalf of the CFA Society of the Philippines and the BTR, we would like to thank all of you for taking time out and attending this webinar. It's going to be a very exciting webinar wherein concepts will be discussed clearly and concisely by our speakers. I'd like to thank in advance our speakers, Deputy Treasurer Santana, and of course, Mr. Ricky Madatu, CFA, and Mr. Trinidad, also from the BTR. I'd like to thank you in advance for the time and effort that you're actually going to put in so that our participants can learn from you. Again, thank you very much for joining us. I turn it back over to you, Tony.
Thank you, Rob, for the warm welcome. Kindly turn your attention to the slides for some housekeeping reminders. Just a few reminders again. Kindly mute your audio when not speaking to prevent any background noise. Aside from that, please write your comments or your questions to the speakers in the public chat space. Introduce yourselves by telling us your full name and organization. And kindly note that this webinar will be recorded. Okay, so to start off our webinar, let me introduce you guys to our first speaker. So joining us today to talk about the basics of bonds is a financial professional with over 10 years of experience in the capital markets, with posts in both asset management and treasury. He started his career as an investment specialist, marketing mutual funds managed by ATR Kim Eng Asset Management or ATRAM. He then moved to become a fixed income and multi-asset trader and fund manager in the same institution. He then joined Metropolitan Bank and Trust Company or Metrobank, where he served as a senior trader and eventually the head of credit trading department, handling both the sovereign and corporate credit trading responsibilities of the bank. So currently, he is the head of fixed income of Pru Life UK Investments. He was recognized as one of the most astute investors in the local currency bonds in Asia by the Asset for 2011 and 2013, and one of the most astute investors in Asian G3 bonds by the Asset for 2015 and 2016. He is a frequent lecturer in the seminars organized by Money Market Association of the Philippines, or MART, ACI Philippines, as well as CFA Level 1 review classes of the CFA Society of the Philippines, focusing on economics, fixed income, portfolio management. He graduated from the Ateneo de Manila University with a degree in development studies. He is also a CFA charter holder. Let us please welcome Mr. Vicky Madatu, CFA.
So good afternoon, everyone. Thank you for having me here, to our hosts. All right, so as you may have heard, I have been living and breathing fixed income for several years already. So hopefully by the end of this short webinar, at least in this portion, you'd get to have a clear grasp of what fixed income is. And especially in terms of its use for your portfolio and your investment needs. Next slide, please. Next slide. All right, so here is just a quick summary. Can you go back to the previous slide? Here's a quick summary of what I'll be talking about. So first off, we have a bonds overview. So what is bonds? What's the rationale behind fixed income investments? Then we go deep into basic components of bonds. And then we get to the coupon setting or the interest rates and how it affects the price of the bond and as investors. And we get into the returns and risk of bonds. And last off is why do we invest in bonds, or what's the usefulness of bonds or fixed income investment for your portfolio. Next slide, please. All right, so what are bonds? So a bond is basically a loan issued or sold by a borrower or purchased by a lender. So it's really a contractual agreement between two parties. So in everyday parlance, when someone borrows money from us, then of course you have to consider the amount. You have to consider when the borrower would pay you the amount, and of course, if there's interest involved in the said loan. Borrowing by way of issuing bonds is one means governments and corporations use to obtain resources and capital to fund their projects or initiatives. So there are other means to gather capital, and bond investments is one of them. Next slide, please. All right, so bond investments is actually part of a broader asset class known as fixed income. So when you talk about fixed income investments, it's really about three things, or three main factors that are considered. One is a fixed interest rate. That's why you have that term fixed income. Periodic payout, meaning there's a set date where this interest would be paid out. And of course, a set maturity, meaning the tenor or the duration of the said debt. So as long as you have these three components, you know that you're talking about bonds or fixed income investments. Next slide, please. Next slide, please. So, all right. So when talking about bond investments, I think one usual way to explain it is really to differentiate it between stocks or equity investments. So if you just click, so we could see the text. So when you talk about stock or equity investments, it's really an ownership. So for example, you own a part of ABC company. So ikaw yung may-ari ka. You're part of the owners of the company. You're a shareholder. So that's basically how you view stock investments. But when you talk about bond or fixed income investments, you click this. That particular company that issued the bond owes you, meaning ikaw yung inutangan. So parang ikaw yung nagpautang dun sa kumpanya. So let's say, think about a company. So if you own a Jollibee shareholder, if you're a Jollibee shareholder, you own part of Jollibee. But if you're a Jollibee bondholder, you lent to that company. May utang sa'yo yung kumpanya na yun. So really, that's really a very basic differentiation between stocks and bonds. So I hope that's helpful for you, for those who are more familiar with stock investments. Next slide, please. All right, so now we get down to the basic components of a bond. So when you talk about the basic components, we'll be talking about issuer, the face value and the price of a bond, the coupon and the frequency of a bond, and the issuance and maturity date. So we'll get to these factors one by one and how it really connects with one another. So first up is the issuer. I think this is the most important component. So when you talk about the issuer of the bond, you're talking about the borrower. This is the entity that promises to make the payments, both the coupon as well as the face value or the amount that you lent to the bondholders. So when you talk about examples of issuers or borrowers, of course, you have governments or central governments like the Republic of the Philippines, and you have corporations borrowing. So you have Metrobank, Ayala Corp, SM Group as one of the examples. Now, one thing to consider here is that no two borrowers or issuers are the same, meaning they all have different factors that they are considering, and they have different industries, different for central governments, different geographic considerations, the population, etc. So again, what I want to glean from this slide is that there are no two borrowers or issuers are the same. Next slide, please. So now when discussing about bond issuers, one thing to differentiate different issuers or borrowers is their credit rating. So when you talk about credit rating agencies, these are independent rating agencies that analyze and publish ratings across all types of issuers. So really, it's just a tool that investors could use to really see how the company is on a very broad basis, meaning each issuer is given just one grade, or each issue is given one grade, and that's how you can judge on how the strength of that particular bond. So when you talk about ratings, it considers several factors, and this is just a small list. So this is limited to company history and recent developments. So how strong or how long has this company been in the market, or how long have they been operating? We also consider short and long-term corporate strategy. So what's the future? What's their game plan? Especially this is since we are in a crisis now. That's one of the things that you have to consider. Also, what's the strategy for this particular borrower? You have the analysis of business and financial risks, and analysis of the management team. So who are the leaders? So again, when you talk about credit rating agencies, these are the things that they are considering. So each issuer can be categorized in a particular rating or credit rating. So you have certain letters that would indicate their strength. So in terms of a more broader classification, you could actually classify them as investment grade. These are the higher rated issuers. So you would consider them as as a more stable borrower, and then you have the non-investment grade or weaker borrowers. So really, it's just giving them a grade in terms of how they would be able to pay you back, or their ability to pay you back in their bonds. So again, this credit rating agencies, they can upgrade or downgrade a credit rating in terms of outlook, and eventually the credit rating itself. So later on, we'll be discussing what's the implication of a particular credit rating to a borrower. So again, that we're in this discussion of the bond issuer. So again, this is just one of the differentiation per borrower or per issuer. Next slide, please. So now, just to bring this closer to home, we'll be talking about one particular borrower, which is the Republic of the Philippines. So in terms of an issuer profile, again, this is just a short list. There are so many factors to consider, but these are the things that I would want to highlight. So for example, when you look at a particular borrower, in terms of this one, this is a government borrower. You have the Philippines as part of an emerging market. So that counts for a lot when it comes to issuers, and when it comes to those who are considering this particular issuer. You have your GDP, you have your population, you have your GDP per capita, you have your debt to GDP. So again, there's time is limited, so I don't want to really delve deep into how these factors affect the issuer. But again, this is something that we would want to consider. So when it comes to credit ratings, all three of the major credit rating agencies have grade for us. And in terms of the total market, when it comes to Philippine government bonds, at least those listed in the exchange, it's a large market. It's a 7.3 trillion market. In terms of total outstanding bond, almost 80% of that is in peso. So when you talk about government securities, it's not just peso. The Philippines, at least this particular issuer, also has 18% of dollar bonds that they have issued, and 4% either to yen, CNY, or euro. So again, I'm just giving you an example of a particular issuer, which is the Republic of the Philippines. Next slide, please. So just to delve deeper into the bond market closer to home, when you talk about the Philippine fixed income market, it's actually a 9.6 trillion market. It's roughly 3 times larger than the PCOM or the PSEI, and it's quite frankly a much more liquid market in terms of the turnover on a daily basis. So when you talk about the Philippine fixed income market, 3/4 of that is really on the government side, and 1/4 is really on the corporate. So again, when considering a particular issuer, you also consider the environment where the issuer is in. So I think this is the main point of this particular slide. So when you talk about the Philippine corporate bonds, it's a 2.3 trillion market. So it's roughly 1/3 of the government bond market. It's not just also peso. Actually, peso issuance is just around 60% of the corporate market. You also have dollar bonds, which is 40%. This one is marketed globally. So when you talk about corporate issuers, we currently have 53 corporate issuers listed in PDEX. So when you talk about PDEX, this is the Philippine Dealing Exchange. So this is the exchange for fixed income market. So you have your PSEI for your stocks, and you have your PDEX for your bond market. So I'm pretty sure some of you are not familiar with PDEX, but yes, there is that fixed income exchange also. So when you talk about the top 3 largest issuers, both in peso and dollar combined, you have there your San Miguel Global Power, you have your BDO, and your Ayala Land. So again, these are also very familiar names to you. So of course, you know their stock, but at the same time, they are also very heavy borrowers. So again, there's that distinction between bond investment and stock investments, and how companies can actually generate capital from these 2 sources. Next slide, please. Now, after talking about bond issuer, let's talk about what is the bond face value? So the face value or principal of a bond is the amount of bonds bought by the bondholder. So the face value of the bond is also the amount to be received upon maturity. So again, this is where principal is being explained. So the face value of the bond also determines the amount of coupons to be received. So later on, we'll discuss how the face value of the bond or the face value that you bought from the issuer affects the amount of coupon that you get. So for example, for starters, there's a client A bought 1 million face value of a 10-year ROP. So ROP is just a shortcut for the Republic of the Philippines. So we were talking about that, this issuer in the primary market. So if you look at the diagram, you have your issuer, your Philippine government, going into the primary market. So this particular issuer issued 30 billion. So as an investor, you bought 1 million. So you lent 1 million as part of that 30 billion borrowing. So I hope you get that. That's the bond face value that you're holding. So next slide, please. So once you have the understanding of the face value, then we talk about the bond price. Now, the price represents the value of all the cash flows of the bond, coupons and maturity value. So I don't want to delve deep into the math behind this, but basically it's really the present value of all the cash flows. And that's the one price that represents all of those cash flows. So during the primary issuances, so we're just talking about the primary issuance, most bonds are valued at par or at 100 or 100%. So the price of the bond is affected by the general movements of interest rates. So that's after in the secondary market. So let's just focus first on the primary market. So for example, you have your client A, you have your 1 billion face value that you bought early on at 100 price or par value of a 10-year ROP in the primary market. So you have your face value and the price. So since the price is at par or 100%, then that's the market value of your bond at the primary issuance. So again, we're talking about primary issuance. So let's move on to the other components. So just to summarize, the bond face value and price. So you're an investor, you bought 1 million of ROP, 3%. So later on we'll discuss the coupon rate at par or 100 with market value of 1 million. So that's really the flow, at least for those two components. So next stop is coupon setting. Next slide, please. So okay, so coupon setting, the coupon of the bond is the set interest rate that the issuer promises to pay the bondholder. So the coupon is an annual rate. So why coupon? So before, when they were issuing bonds, they were actually, or investors were actually given coupons, paper coupons that they used to redeem or to get their interest rate for a particular bond that they bought. So right now, since everything is electronic, so it's not necessarily, you don't necessarily need a coupon, but the term stick. So that's why you call the interest rate of a bond a coupon. Now, coupon frequency sets how many times the bondholder receives part of the coupon of the bond. So later on, we'll discuss, you'll see the equation. So the coupon formula is the coupon rate divided by the frequency times the face value. So let's move on to the example. Now, for example, you have your ABC Corp. You issue a 2-year bond with a 2.5% coupon, loss of tax, on July 1. So investor bought 1 million face value. So we discussed that early on of that bond. So since you have 1 million, so 1 million times 2.5%, the bond will pay the bondholder on an annual basis 25,000. In total, 50,000 for the duration of the bond, since it's a 2-year bond. So on the first year, you get 25,000 for your 1 million face value. On the second year, you get another 25,000. So total is 50,000 interest rate for the bond that you bought. So very simple. That's why the face value is important in setting how much coupon in peso value you get from the bond. Next. Next slide, please. Okay, so this is just more examples for for you to really see how coupons are received. So on the first one, on an annual coupon is paid on issuance anniversary. So so on July 1, you invested 1 million, so that's minus 1 million. Then on the anniversary, you get 25,000. On the second year, you get another 25,000. That's on an annual basis. Now, if the frequency is semi-annual, then you get half of your coupon every 6 months. All right, but on an annual basis, you still get your 25,000. So again, this is just the difference of an annual, of a semi-annual coupon and a quarterly coupon. So again, this is just in terms of frequency, just to give you an overview of how much you could earn from a bond investment in terms of your coupon income. All right, next slide, please. Now, just to delve deep into the coupon setting, we're going to talk about what determines the level of interest rates or coupons issuers pay when they issue bonds in the primary market. So again, it's not the issuer or the bond investor, when considering a particular bond, it's not a random exercise. So when you talk about interest rates or the coupon of the bond, it's something that is really a reflection of several factors. So we'll be talking about those things. So again, let's go back to our discussion of credit rating. Next slide, please. So when you talk about credit rating, so it's really just a letter grade for you to see how the strength of a particular issuer. So the higher the credit risk, of course, the higher the interest rate. So again, there's that risk reward dynamic going on. So investors should be compensated for the credit risk that they are exposed to. So again, going back to a more close to home examples, for example, if you're lending to someone, one of the things that you're thinking is, can this person pay me back? So when you talk about credit ratings, it's just really a specific grade that you're giving to that borrower. So given that very basic example, that's basically what you're doing when it comes to credit ratings and coupons or interest rates. So if it's a riskier borrower, then you would want to be compensated for that credit risk. So when you say credit risk, it's the risk of them paying you back or them paying you the interest rates that they promised or the coupon that they promised on the bond. So generally set by comparing similar credits as well as using credit ratings as a basis. So just to give you a very easy example. So let's say these are several governments or central banks that are borrowing. So let's say they want to borrow for 5 years, dollar bonds. So they want to issue dollar bonds. You want to issue in dollars, dollar denominated bonds. So if you're the US, since you're AA and your outlook is stable, so we're talking about credit rating, you could borrow for 0.20% for 5 years. Quite low, right? So now if you're South Korea, you're AA, you have a stable outlook. If you want to borrow for 5 years, you get 1.15%. You have to pay 1.15% if you're the issuer. Now, if you're the Philippines, you're BBB+, so you're still investment grade. Currently, if you could borrow for 5 years, just around 1%. Now, if you're Vietnam, now we're into the non-investment grade, you're BB and you're stable. If you want to borrow for 5 years, you have to pay up 2%. Or if you flip that, if you're an investor, if you want to lend to Vietnam, since ganito yung credit rating niya, then they have to pay you 2%. So that's really a very simplistic approach to it, but this is market prices already. Now, if you're Sri Lanka, you're B-, but still have a stable outlook. When you want to borrow, it's 12%. So you can see here the difference of AA to a B-. Now, if you're Lebanon, you're CC and you have a negative outlook. If you want to borrow, you have to pay 60%. So if you're an investor, you're receiving 60%. Ang laki, di ba? So again, this is just one factor when you're considering about coupons or interest rates. All right, so let's move on. Another thing to consider when it comes to coupon setting is the economic conditions. Next slide, please. All right, so this is a very textbook approach. So I don't want to belabor a lot of these things. So previous slide, please. So when it comes to inflation, the higher the inflation rate, the higher the returns for investors. So again, it's basically the context of the environment. So if the inflation rate is very high, then if you want to invest in a bond, you would want to receive higher coupons for that particular bond, given that if you trade off investing to spending, this particular rate has to be larger in terms of the your decision point. Now, when it comes to economic growth, on a very basic approaches, if the expectation is for high economic growth, then you would want to have higher interest rates as well. Again, there's that trade-off when it comes to saving or investing in a bond as compared to spending. Given, let's say, the economy is really doing great, then if you're an investor, you have a choice. Do I invest it in my business, invest it in stocks, or do I invest it in bonds, which is paying me just fixed interest rate, as compared to, let's say, investing in stocks or investing in your business, which has in an economic environment that's very friendly for businesses. Then again, there's that trade-off. But very basic rule of thumb is that when there's low growth, you'd expect yields to move lower in terms of interest rates. Now, if there's slower inflation, then also interest rates would be much lower as well. So again, this is just to give you a basic handle of how economic conditions affect coupons or interest rates. Next slide, please. Now let's talk about liquidity. So in terms of liquidity, the higher the liquidity, so again, this is just a rule of thumb, the lower the interest rate investors would require. So liquidity is measured by breadth or the number of participants. So for those stock investors, for sure, this is something familiar with you. So of course, you would want to have more participants in terms of bondholders, meaning there are more people that would want to sell or would want to buy a particular bond, then that would affect the coupon setting as well. And also the depth of the market. So this is the volume available in both the bid, if you're buying, and offer side, if you're selling of the bond. So the table to your right is really the amount or the volume of face value for the Philippines. So if you can see here in the black column, most of the borrowings of the Philippines are concentrated in this year, so 3 to 7 year. So this is basically just showing to you that as investors, a lot of them are really wanting to invest in bonds in this tenor, so 3 to 7 years. So again, as an issuer, you would want to issue where the market is. So again, this is just one of the components of coupon setting. Later on, we'll have that overview, or we want to mix all of these factors on later as we discuss further. Next is supply and demand. Next slide, please. All right. One of the things to consider also when it comes to coupons or interest rates is the amount of supply and the amount of demand. So when you talk about supply, this is basically set by the borrower. So if you're the borrower, you are the one sending out how much do I want to borrow? What's the size of the bond that I want to issue? So primary issuances are normally announced beforehand to check which tenor and yield would have demand. So again, if you're a borrower, they would see which tenor ba yung attractive for investors right now, and at which rate would investors be attracted to buy into a bond. Okay, so that's on the supply side. Now, when it comes to the demand side, this is the amount of bids in a primary issuance. So, for example, if you look at the diagram to your basically, the Philippine government would want to borrow 30 billion. Now, 60 billion is buying that 30 billion issuance. So you'd see here that the demand is actually quite high. So that's what you call the bid to cover ratio. So meaning if you have 60 billion in demand, you have 30 billion in supply, then that's a 2 times cover or bid to cover ratio. So again, that would affect the interest rate. So if there are more people wanting to buy the bond, then interest rates or coupons would actually be set lower. Meaning, for the issuer, sila yung hinahabol. For the borrower, sila yung hinahabol in terms of the interest rate that they want to give to the issuer. So again, I just want to show you the dynamics of what affects coupons and what affects interest rates. All right, so next slide. All right, so now we get to another factor, our basic component of bonds, which is the issuance and the maturity date. Now, when you talk about the issuance date of a bond, this is the start date of the agreement of the bondholder and the issuer. This is also when the bondholder turns over his principal or invests the cash to the issuer. All right, so very simple. That's your issuance date. That's the start of your contract. Now, when you talk about the maturity date, this is when the issuer repays the principal of the bonds and ends the agreement. All right, so again, the table in your screen is really just a cash flow illustration for you. So issuance date, the red part, that's when you pay, or that's where you invest your 1 million to the issuer. So the next few dates, you get your coupon. On the green number, that's when you get back your principal on the maturity date. So very simple. You have your issuance and you have your maturity date. Next slide, please. Now, the difference of the issuance and the maturity date is what you call the tenor of the bond. All right, so if it's a 2-year, so that's your 2-year tenor. That's the difference of your maturity and the issuance date. So the longer the tenor of the bond, the greater the risk attached to it. So you have to think of it. If your friend comes to you, okay, pare pahiram ng 1 million, bayaran kita in 1 year. So 1 year, not so long. Again, when it comes to decision points, it would matter how long they would pay you back. Paano pag sinabi niya, okay, bayaran kita in 5 years? So mapapaisip ka, there's that difference of tenor, or how much or how long would they pay you back. So kung 1 year payback period, that's you would consider, okay, in 1 year, do I see this borrower still okay? Can they pay me back in 1 year? Maybe, maybe not. But in terms of 5 year, kung 5 year na yung tenor ng utang niya sa'yo, then that would be a longer period, meaning that's a greater risk for you. Meaning there's so many things that could happen within 5 years. Much more than what could happen to that person in 1 year. All right, so that's why there's that difference in risk. So as an investor, you will demand a higher coupon for a longer term bond compared to a short term bond. All right, so if you look at the Philippine GS yield curve, so this is really, when you talk about yield curve, it's really just a graph of the bond tenor at your x-axis, bond yield at your y-axis. So you can see here that it's upward sloping, meaning the longer the tenor of a bond, the higher the interest rate. So in my example here, difference of a 2-year to a 20-year bond, meaning what's the difference of me lending to the government for 2 years and lending to the government for 3 years, for 20 years, is around 1.3%. So meaning it just goes to show you risk, or the amount of risk that you would want to take. Also, because you took a higher risk, then you get to have a higher interest rate. Meaning, kung 2 years ka lang, you get 2.2% coupon every year for 2 years. Now, if it's a 20-year bond, you get 3.5% every year for 20 years. Again, if you hold the bond. So again, there's that risk and return dynamic. So the tenor of a bond is really well, it dictates a huge part of the risk of a bond. All right, so I hope you get that dynamic. So the longer the tenor, the higher the risk. Next slide, please. Now we get to the component summary. So I'll try to illustrate to you all of the components in this one slide. So you have your bond issuer. We talk about that. The difference is there's no two issuer that's the same. It could be a government, corporation, then you get to your primary market. They issue a bond, which pays a periodic interest or the coupon and repays at principal at maturity or the maturity date. Now, on the secondary market, this is where bondholders and lenders could actually trade these particular bonds. Next slide, please. So again, the next slide is really just showing to you the examples that we've set in terms of all of these components. All right. Okay, so I think important right now to discuss to you what is yield to maturity. So again, you have your coupon, you have your interest rates, but what is yield to maturity? Now we're talking about you as a bondholder. You already have that bond on the primary issuances. All right. Can you click that one more time? All right. So while the coupon of the bond is set or fixed upon issuance, so it's really a contractual agreement already. The yield to maturity or YTM of the bond is ever changing, meaning it's depending on market circumstances. All right. So for example, if you bought a bond at 3% for a 10-year bond, then you get that coupon 3% every period or annually. So it depends really on if it's annual, semi-annual, or quarterly. That we discussed that earlier. Now, in terms of the market value, this is actually important when it comes to trading the bond already, or if you want to sell the bond in the secondary market. So when yields rise, the price of the bond decreases. So these are, we're talking about very broad rules already in terms to bond investments. When yields fall or when interest rates fall, the price of the bond increases. So again, we're talking about the inverse relationship of yield and price in bonds. So right now we don't have the time to discuss really the math behind this, but again, I'm just going to show you very basic concepts that you could bring home with you, and hopefully you could study further. Next slide. I'm giving you an example here, which I think would be very useful for you all to apply what is yield to maturity. So for example, investor A bought a 10-year bond at 100% with a 3% annual coupon on issuance date. So all of those factors we already discussed. Scenario 1. So let's say after 1 year, your 10-year bond is already a 9-year bond. So clear. Now, in terms of interest rates, the 9-year bond is right now at 2.5%. So from when you bought it at 3%, right now it's at trading at 2.5%. So that's the YTM already. Now the price of the bond is at 104. So again, there's that relationship. If yields move lower, the price of the bond moves higher. So in terms of the unrealized gain or on your principal of the one you bought early on at par, you get a gain of 4%. So again, there's that math behind that. Again, we don't have time to discuss the math behind it, but again, this is the relationship. If yields move lower, the price of the bond moves higher. Now in the scenario 2, you have your bond, 10-year bond. After 1 year, it's a 9-year bond. Right now it's at 3%, trading at 3%, the YTM, or 50 basis points higher. The price of the bond is at 96.20, meaning there's an unrealized loss of 3.8%. Okay, unrealized meaning you don't have to take into account that loss yet if you are considering to hold your bond. But if you do want to sell your bond at the current YTM, then you would have to sell at a discount or lower than when you bought it at 100. So this is again just showing you the yield to maturity, or the importance of knowing where is the yield of the bond that I bought currently. Okay, again, When we talk about interest rates, the coupon is set, meaning you'll get that every time. But when it comes to the YTM, which affects the price, this is the difference, or these are the two scenarios that could happen. All right, YTM lower or YTM higher. Next slide, please. Now, in discussing YTM, now we get to the returns and risk of a bond. So what are the different sources of returns and what are the sources of risk of bonds? So I think very practical na tayo. Now, sources of return. Why invest in bonds? Coupon income. Investors expect to gain from the regular fixed income of bond investments. So again, that is the obligation of the bondholder to you. So once you buy a bond, you will definitely get your coupon as long as the issuer doesn't default. Another source of return is capital gains. So investors can also gain from the capital appreciation of the bond. So should they sell the bond when the yield to maturity of the bond is lower when they bought the bond? So again, there's that dynamic, market dynamic. So in the earlier example, you could see that. Now, when it comes to sources of risk, next slide, please. And we're talking about downside risk. You have also two. You have your default risk. Now, investors may incur loss should their issuer default from their obligations, particularly in the return of the face value. So this is where the credit rating, the issuer dynamics comes into play. So the main risk really of a bondholder is if the issuer doesn't pay you back the principal or doesn't pay you the coupon on time or at all. All right, so again, default is not just on the principal, but also on the coupon that they promise to give you. Another thing is capital loss. So investors can also incur loss from the capital depreciation of the bond should they sell the bond when the yield to maturity is higher from when they bought the bond. All right, so again, there's that caveat na you have your principal loss if you sell your bond at the secondary market or before the maturity date. All right, and the yield is actually higher from when you bought it. So again, that's the type of risk that is connected to the yield to maturity. All right. So the next slide is what we're nearing the end of this short webinar is why invest in bonds. All right. So given all of the components, given all of the risk and returns, why invest in bonds? Number one, capital preservation. You get your face value so long as the issuer does not default. So as long as the issuer does not default or still intends to pay you back, then your capital is preserved. So this is very different from when it comes to stock investments, wherein there's no capital preservation that is promised to you, meaning it's entirely because of the capital appreciation or depreciation of the stocks. But when it comes to bonds, your capital is preserved as long as the issuer does not default. Now, another thing why invest in bonds, fixed income. Coupon is fixed until the maturity of the bond. It is promised, it is obligated, and you will receive it, right? As long as the issuer, again, does not default. Another thing why invest in bonds, because there is a possibility for capital appreciation. The bond's price can increase as the yields, YTM of the bond decreases. So again, that's for those who are trading the bond in the secondary market or who intends to sell their bonds before the maturity. Another reason for investing in bonds is diversification. Bonds have very different risk and return characteristics to your equity. So the next slide is something that I think would be helpful for you guys. Next slide, please. So again, this is an example of the Philippine financial markets for the past 5 years and for the past 10 years. So this may come off as a surprise for most of you, but this is really a comparison of the fixed income market and the equity market. So in the first graph is really for the past 5 years. For the past 5 years, fixed income has actually been outperforming equities for more than 60%. Meaning, if you invested your capital to fixed income, you would have gained 38.4%. So when you talk about fixed income, this is really the index, fixed income index. You would have gained almost 40%. But for the past 5 years, if you invested it in equities, you would have lost 18% roughly. This is investing in the index of the Philippine stock market. So you can see here, what's the reason behind it? Again, interest rates were falling for the past 5 years. Now, if you look at the past 10 years, you would have the same scenario. For those who invested in fixed income, they would outstrip investment in equities by around 50%. Why is that? Again, we're talking about the economic conditions for the past 10 years. Interest rates have been falling. That's why fixed income markets, for those who diversified, for those who invested in fixed income, at least on an index basis, they would have gained this much for the past 10 years. So again, I'm not saying that just because of these return figures, you should be piling into bonds already. But again, this is where the risk and return factors come into play. This is where diversification actually would benefit you in the long run. All right, so this is just a broad overview of the returns of these two Philippine financial market investments. Final points. Bonds are built on trust and commitment. All right, the issuer promises two things. I pay you back the principal or capital at a predetermined date, or what we call the maturity date. We discussed that again. And I pay interest, meaning the coupons. You pay the regular coupons periodically. So if it's semi-annual or quarterly, then they have to follow that type of payment schedule. All right. So what I want to, on the last point, is that when you talk about these two agreements or promises, it should be set already, meaning all of bond investments are built on this type of relationship, this trust and commitment. That's why for me the most important factor really is the issuer. So who is this issuer when you're considering bond investments in the future? Lastly, in terms of final point, so this is me already selling, not necessarily a particular bond, but really the bond investments or fixed income investments in general. Bond investments should be part of every portfolio, either through direct bond investments or through fixed income UITFs or mutual funds. So I think in terms of diversification, we should be very comprehensive in our approach. So I hope, at least in the few minutes that I have with you, the components that I've discussed, the risk and returns that I've highlighted, there are there's so many things that that needs to be discussed further. But I hope this has whetted your appetite when it comes to fixed income investments. And that ends my presentation. Thank you very much.
Thank you very much, Ricky. So it actually is it's a fresh perspective for me because, Ricky and I have been I've been conducting seminars on fixed income, but for me, looking at bonds as an instrument showing trust and commitment, this is something new. And thank you very much again, Ricky, for sharing your knowledge to our participants. Now, please be reminded that the Q&A session will happen with all of our resource speakers after all of the presentations. And another housekeeping reminder, just a reminder to the participants to not annotate nor draw on the presentations. Okay, so again, thanks, Ricky. Next up, we are honored to have with us this afternoon two resource speakers from the Bureau of Treasury. So our second speaker is Deputy Treasurer Erwin Santa Ana. He handles the National Government Liability Management Portfolio at the Bureau of the Treasury. He is responsible for formulation of national government's financing program and issuance calendar of government securities. origination and execution of peso and foreign currency denominated securities, liability management transactions, and disaster risk financing, overseeing the BTR's programs in promoting the development of the capital market, and monitoring and managing contingent liabilities of the government, including those arising from PPPs. Deputy Treasurer Santa Ana likewise supervises the Information Technology Group of the BTR and was responsible for the modernization of the auction and registry of government securities, the launching of the online ordering portal, and introduction of the mobile app called Bonds.ph for retail investors, among others. He also heads the regional and provincial offices, providing overall support to the BTR. He assumed the position of Deputy Treasurer in October 2015 with extensive experience in public debt and risk management at the Department of Finance and the Bureau of the Treasury. He has a degree in economics and is a lawyer by profession. Now, our third speaker is actually Mr. Arturo S. Trinidad II. He heads the Capital Markets and Debt Strategy Planning Divisions of the BTR. He handles the formulation of the funding and debt management strategies to fulfill the government's financing requirements in line with its overall debt management objectives. Furthermore, he leads the origination, structuring, and execution of capital market financing and liability management transactions of the national government, including sovereign guarantees and market financing transactions of state-owned entities, both in the domestic and international capital markets. He is the senior officer in charge of landmark transactions in various currencies across different markets, such as US dollars, euros, Japanese yen, and RMB. In the domestic capital market, he played a key role in implementing milestone reforms, including the non-restricted trading of government securities, or NRT, the GS Repo program, primary dealer system, GS benchmark and valuation methodology, and modernization of the GS auction and registry systems. Most recently, the introduction of the online ordering platform and mobile app Bonds.ph, making investing in RTBs or retail treasury bonds easy and convenient for Filipinos inside and outside the country. Prior to joining the BTR in 2013, he was with the International Finance Group of the Department of Finance. He obtained his Master's of Arts in Policy Economics from Williams College, Massachusetts, and Bachelor of Science in Mathematics from the University of the Philippines, Diliman. Ladies and gentlemen, I turn you over to DTOP Santa Ana and to Mr. Trinidad.
Hi, good afternoon. Thank you, Tony, for that kind introduction. And thank you, Ricky, for making my job this afternoon easier, for providing the building blocks for fixed income and bonds in general. So we'd like to thank CFA Society Philippines for giving us the opportunity to speak in today's webinar and share details of our ongoing RTB issuance and discuss our new pandemic-friendly and game-changing innovation that is the Bonds.ph mobile app. There have been 23 previous retail treasury bond issuances or tranches, with almost 2.6 trillion in RTBs having been issued from 2001 to 2019. The most recent RTB 23 this February of 2020 raised about 250 billion in new subscription and 60.8 billion from the bond exchange program. I would like to share that in just a few days, we have already breached the amount of new money we raised last RTB. And talk about demand, as Ricky mentioned, we offered 30 billion during our public offer when we were pricing this bond. And we were able to raise at that very auction about 200 billion for RTB 24. This shows sufficient liquidity in the current macroeconomic environment. We can see on the graph presented how much the RTB market has grown. It has indeed proven to be a reliable source of funding for the Republic, and at the same time, a sound and solid investment for the public. RTBs aim to provide retail and individual investors with a safe sorry about that. I got cut off. So I was saying that RTBs are actually instruments that provide a safe and affordable investment outlet. So looking at this slide, from RTB 20 to RTB 22, we have raised a total of 613 billion. And 51% of the subscriptions are coming from retail and individual investors. So this is a proof that more and more retail and individual investors participate in these RTB offerings. Moreover, our initiatives are motivated by the thrust to reach even more individuals with the introduction of the RTB online ordering facility last 2019 and Bonds.ph mobile app for this tranche. Through these, not only we are reaching out to more individuals, but we're also providing our overseas Filipino workers, our kababayans abroad, the means to invest even while away from home. RTBs are debt instruments issued by the Republic through the BTR that pay periodic interest payments with the eventual return of the principal on maturity date. RTBs, unlike regular auctions that we conduct here at the BTR, are made available directly to investors via public offering. So now, as I've mentioned, we are in the middle of the offer period for RTB 24, which we also call Progreso Bonds para sa Bayan. So it started last July 16, and it will end this Friday, August 7. So this is actually timely because we still have an opportunity to go out there, or you just stay in the comforts of our home and actually invest through our online channels. So why do we issue RTBs? What benefit can the Republic derive out of issuing RTBs? So first, it's actually lower in terms of cost than borrowing abroad. These potential savings translate to more resources to fund priority projects of government. Second, financial inclusion. By making RTBs more accessible and affordable, the government is providing Filipinos a safe and viable investment in line with the BTR's thrust of promoting financial inclusion. Third, economic resiliency. The success of RTB issuances reflect investor confidence in the Philippines, and therefore allowing the economy, it actually reduces reliance from foreign currency, therefore allowing the economy to be less vulnerable to global economic shocks. And of course, it is a key part of our capital market development agenda. And the success of RTB issuances reflect the confidence in the Philippines, which likewise reflects on corporate borrowers, as mentioned in the previous presentation. So being the benchmark of all other issuances in the country, we allow the corporate sector to actually follow suit. As part of the advocacy of RTBs, we would like to impart the spirit of nation building. Every peso invested in RTBs will be directed towards the country's emergency, recovery, and resiliency funds. This aims to fight against the effect of COVID-19 pandemic by supporting our infrastructure projects and help the country's healthcare system. It will also help us provide assistance to our unemployed fellow Filipinos and also our OFWs who have suffered under this global economic environment. We also enjoin everyone in looking beyond the economics of RTBs as an investment and start putting a premium on how your investment shall be used and see it reap social dividends for the Filipino society. Okay, so why are RTBs any good for individual investors? Number one, they are affordable. They are available for as low as 5,000. Number two, they are convenient and easily accessible to individual investors. You can invest online or over the counter through any of our selling agents. BTR also now has its online facility where you can purchase RTBs through our website, www.treasury.gov.ph, or you can download the mobile app of Bonds.ph. Third, they are low risk. They are direct and conditional and general obligations of the Republic of the Philippines. Earlier, there was a mention of credit rating, and this is actually built on trust and commitment of the issuer. And now you're talking to the strongest entity who has the best credit rating in the land, which is the Republic of the Philippines. So talk about the credibility and the repayment capacity of the issuer in this case. Fourth, they provide quarterly interest income. So you will have periodic cash flows. 5, they have a relatively higher yield than other investments. If you look at prevailing time deposit rates, then it is arguable that our interest rate, which is at 2.625% per annum, is considerably higher than those time deposit rates. And they are negotiable and transferable. So there is an active secondary market for RTBs, which provides an easy exit mechanism for investors should that need arises. Okay, so I would just like to illustrate the profit dynamic of RTBs if bought during the primary offer period, which, as I've said, is until August 7, until this Friday. So also on the assumption that the bonds are actually held until maturity. So we have a calculator in our website, and in this example, a 50,000 peso investment would yield 5,250 pesos net of the 20% final withholding tax. And this return is actually for the 5-year period. So if you compare that with the time deposit, which we assume to be at 1.125%, then that would yield you 2,250 pesos over 5 years. So that makes the RTBs actually earn more, no? From the perspective of the investor. On the secondary market, we cite an example here of RTB 5-11, which was issued last December 2017. Of course, that bond was issued at par. After issuance, it can be seen here that prices went on a discount, meaning lower than 100, as the rates increase. So this is actually an application of the inverse relationship between price and yield. So now, as interest rates have significantly declined following the easing by the BSP, we have seen RTB 5-11 go into premium or above 100. So these being said, buying or selling RTBs in the secondary market will be done at the prevailing price during the transaction date. And also note that in doing so, it will be subjected to the customary fees by the broker that will facilitate your secondary market transaction. Now, so you might ask, no? I mean, how do you invest in RTB24? There are actually 3 ways. We have more than 30 selling agents out there that help us distribute these bonds. So one option is, of course, to go to the bank branches of these selling agents. But of course, there's risk in going out of our homes now because of the pandemic. So we have actually made it more convenient for you. The second option is the BTR's website, no? and using our RTB online ordering platform. So the experience starts at the BTR website. And then when you have read and understood the terms and conditions, then you will be redirected to the e-payment portal of our partner banks. So far, Land Bank of the Philippines, Development Bank of the Philippines, and China Bank have direct access to the portal, meaning account holders of these banks can actually experience a seamless online investing using the BTR website. We have also linked with First Metro Securities Brokerage Corporation for the ordering facility. So if an individual invests through First Metro Sec, they can actually use any InstaPay or PesoNet powered bank to fund their transaction. It's quite open, no? It doesn't have to be a Metro Bank deposit account. So long as your bank has InstaPay or PesoNet capability, then you can also invest via First Metro Securities Brokerage. And of course, the newest channel that we have, which we are very excited about, is the comforts of actual investing using your mobile phone. And it's available for download in the App Store and in Google Play. So this is Bonds.ph. And I will discuss with you how to invest in this app. So the Bonds.ph mobile application is developed in partnership with Union Bank of the Philippines, which happens to be one of our issue managers for RTB24. They are also a perennial GSED, as we call it, Government Securities Eligible Dealer, which participates in the primary market of government securities regularly through our auctions. So Union Bank then tapped the Philippine Digital Asset Exchange Corporation, which actually, or PDAX, which actually developed the Bonds.ph mobile app. So, and the novelty of this setup is that we are using for the first time in a pilot basis the distributed ledger technology. So it actually works at the back end of the application. So during our launch last July 16, no less than the central bank governor, the Secretary of Finance, the Secretary of Socio-Economic Planning, and Union Bank's vice chairman invested using Bonds.ph. This is a message of strong support to this initiative. And they were among the first investors using the app. We demoed it live for the public to see. So it's very easy and convenient to invest using the app. We have seen also international recognition in the undertaking. Why? Because, as I've mentioned, the distributed ledger technology was piloted in this mobile app. So DLT, or commonly known, or maybe it's more popular to be called as blockchain. So our colleagues from the international community have actually praised this endeavor and actually are very proud of the accomplishment of both the Bureau of the Treasury, PDAX, and Union Bank for actually launching this mobile application powered by blockchain. Now, on to the steps, no? And this is the final slide that I'll be discussing with you. So the process of using Bonds.ph can be summed up in 3 major steps. Number 1, creation of the account. Second, cashing in. And third, the actual purchase of the bonds. So to start, a user can simply download the app for free from Apple Store or Play Store, depending on your device. So one needs a valid email and a mobile number to set up an account. So after checking the tick boxes to accept the user agreement, the customary documentation, the user can now undergo the KYC verification process. This is actually standard for any account opening. So you must have had an experience with eKYC using e-wallet providers. So just like that, the user will be required to enter personal information consistent with those e-wallet providers. And of course, you need a valid ID. So the KYC also entails the user to take photo of their ID and take a selfie with the ID. So it's a very easy and quick process. Upon submission, it takes about, because of course, Union Bank will be doing the verification process. So the verification process could take a maximum of 72 hours. But of course, we have already told
I think Dita Erwin got disconnected. Can you hear me? So I can proceed.
Yes, we can hear you.
Okay. From where he left off, upon submission, as you mentioned, it would take around 72 hours to complete the verification process. And then once fully verified, the user will receive an email confirmation. After verification, the user can cash in through different channels, namely InstaPay or PesoNet powered banks, and e-wallets in GCash and PayMaya. Note that for these, there are varying fees for cashing in. InstaPay and PesoNet transfers for most banks are free until the end of the year, while GCash has a 3% cash-in fee, and PayMaya has a fixed fee of 5 pesos. After entering the amount desired for investing, the user will receive an email containing the instructions on how to finish the cash-in procedure. So let me just also emphasize that while you can see in the app it's powered by Union Bank, this is bank account agnostic, since you can transfer or you can cash in using different channels. And you're not required to open a Union Bank account if you set up Bonds.ph account. So it's very accessible for everyone. Then once funded, it takes just 6 steps to finish the purchase of RTB24 using the Bonds.ph mobile app. So it's that simple. Note that the minimum investment amount is 5,000 in increments of 5,000 thereafter. There is also a maximum amount of 500,000 per transaction done in the app, but you can do multiple transactions if you opt to invest more. Note that for the purchase of bonds, the app can only be used during the offer period. Furthermore, if the initial purchase of the RTB24 is made through the app, the investor can use the app to redeem or sell their investment should they need the cash prior to the maturity of the bonds. So all the proceeds, interest payments, principal maturity are automatically credited to your Bonds.ph mobile wallet, which you can also cash out through InstaPay, PesoNet, GCash, or PayMaya. And lastly, I think just to emphasize again that our offer period is until this Friday, August 7. And the online ordering platform in the Bureau of the Treasury and the Bonds.ph mobile app will be available only until August 7. But and then after that, you can buy RTBs through the secondary market. I think Dita Irwin is back, so if he has final words to end this presentation.
Thank you, Art, for filling in for a little bit. Actually, that's it. And thank you for listening to our presentation. And we will be happy to answer questions and clarifications about the RTB and the app itself. So you can always reach us also through our website and social media accounts should you encounter difficulties regarding investment in RTBs. So as we say for this issuance, Ahon Pilipinas, Progreso Bonds para sa bayan. Thank you very much, CFA Society Philippines.
Thank you very much, Dito Santa Ana and Mr. Trinidad. So we will now proceed to the Q&A session. For our participants, please write your comments or questions to the speakers in the public chat space. Introduce yourselves by telling us your full name and organization. So we have a few questions already. Probably the first one I can address to Ditop Santa Ana and Mr. Trinidad. This is from Basil Go of Security Bank. Do you intend to use Bonds.ph for any other issues?
Okay. I think Dita Pervin got cut off again, but let me take that. So while this is the pilot issue that we use the Bonds.ph app, I think that's also the intention to widen it further and making available other bonds that will be issued by the Republic or by the Bureau of the Treasury. So that definitely that's something that we are very much interested in.
Thank you, Art. Okay, so probably the next question I can address to Ricky. There's a question from Mr. Grospe. He's asking what are index bonds? Maybe you can expound on that. And in addition to that, well, there's another participant. This is Ses Ong. She has a question on the composition. What is the composition of the bond index?
All right. Okay, so just to describe what an index bond fund is. So when you talk about an index, well, similar to, let's say, PCOM index. So I think I could start there. It's an index wherein you have 30 companies that's included in that index. So the value of that index is really the aggregate contribution of all of those index members. So meaning all of those 30 companies. So if the index goes up, you know that most of the companies inside that index is higher for that day. So similar to the stock index, a bond index is really just a collection of different issues or different bonds. So when you talk about a bond index, there are several kinds. So for example, the index that I was highlighting earlier on was really the government bond index. So a government bond index, either through a mutual fund or through a UITF, is really composed of several bonds issued by the government. Or there are also bond indices that are composed of both government and corporate. Some of them are composed of different central banks or sovereigns that are issued in dollars. So again, really just a bond index is really just a collection of all of these bonds, and the value of that index is composed of the value of each bond in aggregate. And in terms of where you can access this, then again, you have several providers of UITFs and mutual funds so that you can consider. You would see there the type of risk that you would encounter. So for example, specific bond index could be short-term, meaning a money market fund. So a money market fund is very low risk in the sense that the maximum tenor of the bond, at least the average tenor of that bond is less than 1 year. Then you have your intermediate bond fund, meaning the tenor of all of the components of that bond is up to 5 years only, meaning, again, we have that discussion earlier on, the longer the tenor, the greater the risk in terms of interest rate risk and credit risk. And then you have your long-term bond funds, meaning it could be higher than 5 years. So when you talk about bond index, yes, there are several kinds actually out there. Yeah, I think, I hope that answered your question. You are in mute, Tony.
Sorry. Okay, so just a follow-up, probably to you as well, Ricky, as a follow-up to your discussion on bond index. This is from Enrique Fausto. He's a charter holder also. So is there a way to access historical bond price, bond index prices without the use of a Bloomberg terminal?
All right, so in terms of historical prices, outside of Bloomberg, I think it's not as accessible compared to, let's say, a stock index or a stock. So if you notice, it's extra difficult for bonds because of the maturity, meaning once that it matures, it's gone forever. So at the same time, there are several issues on a per issue or per bond basis. So again, maybe that could be addressed by our by BTR. Maybe we could have that type of access in terms of historical prices, because right now it's not as prevalent. Maybe you could visit the PDEX website as well,
Yeah.
in terms of the current yields, and all of the historical prices are, at least the historical yields are there as well, in terms of
Mhm.
the benchmark bonds. But yeah, you could access through PDEX, but I think, yeah, maybe we could have that enhancement also moving forward.
Thank you, Ricky. Um, the next question, I can probably address this to Ditop, Erwin, and Art. Can students without a valid ID avail of the new RTB? Art or Ditop, Erwin, are you both still online?
Tony, can you please repeat the question for Mr. Trinidad and Dr. Ana?
Okay. There was a
Sorry, I got
question
cut off.
from that's okay. From Angela Cresciner, Crescencio, sorry. Can students without a valid ID also avail of the RTB? Maybe for students, what would be an acceptable form of identification on their end if they can avail of the RTB?
Yeah. Actually, first we have to classify now, because for you to be able to invest in RTBs, you should be of legal age. So you have to be 18 and above. As an adult, of course, you can actually get a voter's ID, a TIN already, if you will. So there are alternative identification options for you to get and start setting up an account. So I think it has to be, it's actually open to students who are of 18 years and above, 18 years old and above.
Okay, so the next question, this is from Mr. Gorospe again. How do retail investors enter the secondary market? Normally, this can be through their salespersons, right? But maybe you can expound further, dito, Santa Ana.
Okay. You as individual investors, you should be able to have a broker, no? Because our legal framework here is that we have to be very particular about investor protection. That's why there are brokers that are there to actually help those who want to come in the fixed income or the GS market. So normally, if you are banking with, let's say, Bank X, it also is a GS dealer broker. They also have a dealer broker license, so you can actually transact with the bank that you are actually transacting with now. So the broker will then provide you with options depending on your risk appetite, depending on the instrument that you would like to invest in. So the brokers will handle that for you.
Okay. Thank you, sir. Going back again to Ricky. Sorry, I've going to and from, no. There's another question. I think a lot of our participants are really interested on bond index. So they're just interested in what is the most common bond index being used, probably as a benchmark to the fixed income funds now. Maybe you can expound, Ricky.
All right. So a lot of the bond indices that are used by the fund managers or the asset managers are paid indices, meaning the components of the bond indices are actually you would require to pay for you to access or to see what's inside the index. But there are public indices that are available through the internet and through also Bloomberg. So Bloomberg, of course, you have your Bloomberg indices that market participants like myself could access. So, but again, given that a lot of people don't have Bloomberg access, I think one of the most common or easiest to access is really the BPI bond indices. So you could just Google BPI bond index for the Philippines. So they have that service wherein where they publish several types of bond indices. Actually, quite helpful, and you'd also see there the changes in the price, the components of the bond index itself. So yeah, that's one of the more public bond index out there. And you're welcome, BDI.
And if I may just add, Tony.
Go ahead, Sir Art.
I think just for the benefit of everyone who's really new about bonds and would like to understand more the historical numbers, I think I can refer you to our website, www.treasury.gov.ph. We have a section there on government securities and the historical results of our auction. While it's monthly and on an annual basis, but I think from there you will have an idea over time, especially that government securities issued by the government or the BTR serve as the benchmark for the yield curve and for other issuers in the market. Thank you.
Sir Art, sorry, may I address the next question to you as well? I think in the presentation earlier, it was mentioned that if investors will be redeeming the new RTBs, they can do this via the app as well, the Bonds.ph app. Is that correct?
That is correct. Only if you purchased the bond through the RTB through the Bonds.ph mobile app.
Okay. So in that case, because there's a clarification here that there will be no need for a broker.
That's correct. If it was purchased during the offer period through the Bonds.ph app.
Okay. All right. Thank you for clarifying. Maybe just a last question. So we're receiving a lot of queries from our participants, but I would need to filter to the last question. There is a question specifically comparing savings deposit rates versus fixed income rates. Because there is a participant sharing that the deposit rates being published in the BSP website, for example, it is what they're seeing is that it's higher than the coupon rates of the secondary of the bonds active in the secondary market. Now, maybe you can give them guidance on the difference between savings accounts versus fixed income investment, because at the end of the day, it's really more investment maturity for our retail customers here. So most of our retail customers, they're really comfortable with deposits. So our task here is really for financial literacy, for them to mature in their investments and then move towards fixed income, equities, funds later on. So if I may, let me just do a round table. Ricky, Sir Art, and the top Erwin, maybe just to compare savings versus fixed income, the benefits of each of savings, deposits, and fixed income, just to end our session on entitled Bond 101. Maybe Ricky, you can start first.
Okay, so when it comes to deposits, and actually the main benefit really is accessibility, meaning in terms of the tenor of the deposits, a lot of times it's really less than 1 year. Meaning you could place a deposit for 1 day, 30 days, 90 days, what have you. So again, that's accessibility. And at the same time, you can access it. There are several platforms already, online platforms where you can save, and they are giving very attractive rates as well. But again, you would know that a lot of those rates are not necessarily, are really just for short term, meaning you don't know if the rates would go lower in the next month or in the next year. And that's actually one of the, moving on to bonds, or the difference between a coupon bearing bond. The coupons are set already for, like, for example, the new RTB, it's set at 2.625% for the next 5 years. And that's basically the relationship of a coupon bearing bond and time deposit. For a time deposit, yes, you could have higher rates now. But again, you don't know where rates are going, or at least for those particular instruments, where it is next year. But in terms of as an investor, you would want now, okay, am I satisfied with a 5-year 2.625% income for a fixed income for myself? Is 2.625% good enough for me? And again, you have to consider not just the coupon, but also the characteristic of the bond. Again, if your goal is capital preservation, then you would want to get into a coupon-bearing fund, because your principal is already secured, and you know that your issuer is the Philippine government. So again, that's the dynamics that should be considering when choosing between savings and bonds. Again, there's that tenor component, there's that risk component, the coupon versus rate that could change for a shorter tenor savings account. And yeah, I think that's basically a very simple take on the differences.
Thank you, Ricky. Maybe move on to Art, to Mr. Trinidad. Thoughts on, of course, for our participants here, differences between deposits and fixed income, pros and cons.
Okay, I think let me just try to add from what Ricky already mentioned. I think there's an important slide there in Ricky's presentation. It's really diversification. I mean, between a savings account and a fixed income instrument, if you were really after the liquidity that you need, this much amount in the short term or in the near term, then definitely savings. But it's also important to highlight that if you are sure that a certain portion of your money or is something that you will not use in the next, let's say, 3 or 5 years, where there are fixed income instruments available, then might as well invest it in fixed income instrument rather than having it stay in savings account where you will earn definitely much less. And even if, and I think liquidity is not an issue as well, for especially for instruments like RTB, since there's a very deep secondary market, and so you can liquidate your holdings in between issue date and the maturity date. But of course, being mindful of price movements. But definitely, if you have funds that you can set aside while being assured that you have periodic, then definitely might as well buy the likes of RTBs instead of putting it in a savings.
Thank you, Sir Art. And finally, Dito Erwin, your thoughts, final words for our participants as we close today's webinar.
Actually, if you look at my presentation a while ago, I made as an example RTB 5-11, which was issued December of 2017. My son then was 2 years old. So he has his own time deposit, he has his own bank account, but you know, having learned that there's an RTB at 4.625% at that time, my wife told me, you know, I think I can earn more, you know, with this product. And as you said, there's secondary market here, so I think covered. And it's really timing, because in 5 years' time, my son will be in big school already, will be in grade 1 already. So that is something that we can set aside for him to actually use when he's 7 years old, 2 years from now. So it's really more of the objective, I guess. If you have spare investable cash that you can actually invest, then I'd go fixed income in a heartbeat because of steady cash flows. There is certainty on when you can actually get the entire principal amount back. And in the experience of RTB, we always say that you have to look beyond the economics. So it's really more of actually helping the country, and especially at this time of the pandemic, wherein government revenues are somewhat depressed. So it's really a good time to actually transition to fixed income via government securities, which is the safest fixed income instrument that you can actually invest in. So I guess that's my pitch for everybody to actually consider investing in RTBs. And that's actually a hugot from my end, because that's a personal experience of my son, which actually some of them would actually, you know, find merit, you know, in terms of considering. So there you have it.
So thank you very much to our 3 resource speakers for this afternoon. So this concludes our webinar for this afternoon, entitled Bonds 101. To our participants, kindly expect an email from us for the online evaluation, which would really just take you only 3 minutes to finish. So again, the CFA Society of the Philippines would like to thank our sponsors. Our platinum sponsor is the National Home Mortgage and Finance Corporation. Our silver sponsor is FTI Consulting Inc. And our bronze sponsor is Infinite O. Again, accept our sincerest appreciation for your time and effort in participating in today's webinar. So have a good evening, everyone. Thank you very much.